dive into the markets. Quick, just a reminder with Lighthouse. I think there's some familiar faces, some unfamiliar faces. Anytime someone's talking to you about markets and talking to you about strategy and what to do about it, it's worth just a rehash of, should I listen to these people? What gives them any credentials at all to give me some insight on the markets and what to do about it, what to think about it, etc. So we've been around since 2015. Unique business model. We're an advisor to the farm, but also a grain trader for the farm. Nobody else has kind of put those two things together. We've traded over 260 million bushel of grain. We'll do about 70 to 75 million bushel this year, depending on how crop turns out. And then just that Lighthouse wrap for the farm, our product, our merchandising for the farm includes planning, analysis, hedging, cash trading, and logistics. Basically everything that farm has to do to take their crop from an idea to a check in their hand and to get the best possible value doing that. Lighthouse is set up to provide that service. By the numbers, it's a little over 1 million acres that we market for. Now that map's a little outdated, should be a few more red pins on it, but overwhelmingly in North Dakota, big growth in South Dakota, starting to fan out into Nebraska, Iowa, Wisconsin, Ohio. There's over 20 of us on the team, ourselves as traders. We've got a full-time quant analyst. We've got 2 software engineers that are developing proprietary software continually for Lighthouse. If you've heard us talk about our various AI efforts, our automation efforts, some of the analytics that we'll showcase today, that's all done internally. Our logistics team, our operations team, and then our full accounting team. And then just a reminder, some of what drives innovation at Lighthouse, why we have the market thoughts we do, the analytics we do, the exposure we do, the reach that we do. We don't get paid up front. We don't get a fixed fee, a per acre fee, a way different model than the typical I'm here to help farm consulting model. That's usually, a typical consultant would show up to the farm and say, I'm here to help. Now here's the check that I want you to write me, and I promise I'll do a good job. What Lighthouse is the complete opposite. We don't get paid anything up front. We get a percentage marketing fee when the grain ships. So we're in it from start to finish. We win and lose together with the farm. We have the same risks that they do. So that's powered a lot of our growth and our success because we get paid the same way the farm does. So that's who's talking to you today. If you're here at Lighthouse for the first time, again, a lot of familiar faces or names, I guess, no faces on the call, but a lot of familiar names, but some unfamiliar ones too. That's who Lighthouse is. With that, let's get into the market. So just recapping what's been happening, and if you fan all the way back to 2020 to 2024, you were coming off this multi-year bull market. You were in what was then year 2 and is now year 4 of successful crops all around the world. Your balance sheets were rebuilding, margins were getting tight, and a really unique time because not only was grain price falling, but unlike the previous bear market in the mid-teens, 2000 teens, if you will, this bear market also came with surging input costs. So you're getting less for your grain at the same time. Costs to grow that grain are growing up. It's really been a bit of a vice the last couple of years, especially, and it's made decision making really tough. At the same time, just recently here, grains have started taking off, and as of right now, you've got new crop corn and soybean futures at 2.5-year highs. So if you look at just the new crop contract on a continuous basis, it's the highest it's been in 2.5 years. So for the first time in about 2 years, you've got some choices that have started to move from difficult, do I accept this mediocre price, into a little bit easier, as in this price I have today actually works for the farm. So that's an encouraging thing. We'll talk about the drivers behind it. Soybeans, same thing. And if you look at the soybeans on a continuous chart, you can actually see this is the movement on beans that has been building since all the way back in December of 2024. It got waylaid a little bit with trade war, tariff, and things like that. But the things that were going on in beans have paved the way for recovery that now has beans up in the 1160s. Again, the highest price for new crop beans, a new crop futures month, November of 26 in this case, the highest that's been in about 30 months. So you've got a little bit of optimism here today as it relates to grain markets. So what's been driving that? Obviously, the big thing over the last couple of weeks, when you look at movement of the last couple of weeks here, and specifically Thursday, Friday of last week through what's been happening this week is the conflict in Iran and just trying to determine, the markets are trying to determine what happens next there. And so as a general statement, war in almost any major producing region, certainly of oil or anything, is bullish for commodities. If you look at the Iran situation itself, you have, look at this map that's on screen, you've got the Strait of Hormuz that you're hearing about a lot in the news. All of this oil that's produced in the Middle East transits on ships that have to go around that strait. It's only, what, 60, 70 miles wide right there at its narrowest point. And that's something that Iran has said, we're not going to let ships cross here. They begin attacking, and that there's a lot of just, that's what makes that so high stakes beyond just a general bullishness for commodities of a geopolitical event like this. And then where grains get roped into it a little bit, so certainly energy prices rising is bullish to grains. A huge part of your demand base for grains is biofuel, ethanol for corn, renewable diesel for soybeans, canola, etc. But then the other big one is most of your fertilizer, your nitrogen fertilizer actually passes through this region too. It's produced at the refineries and noted on the screen here and whatnot, and it passes through that strait. So you've actually seen fertilizer prices skyrocket. My chart's out of order here. Fertilizer prices have skyrocketed here. The fertilizer has rallied significantly more than corn and beans have as a percentage in the last little bit here. Fertilizer's up over 50% in just the last 3 weeks, while corn futures have rallied roughly not even 10% yet. So that's one of the direct impacts. If we ban out, and I should preface all this by saying we've asked you for 45 minutes of your time to hear about what's happening in the commodity markets. And when we talk about these things that have just profound impacts on a personal level, that on a just overall world level, we're just specifically focused here on what this means for the grain markets. That's what we're tasked to do today. We can sure grab a beer sometime and talk about what we think personally about all this, but we've got a limited amount of time just to talk about what this means to the markets. That's what we're tasked with here. So what is a conflict like this that disrupts, that centers on major oil producers, that disrupts some aspect of farming? The closest analog you have is the Ukraine-Russia conflict that broke out around this time in 2022, and that conflict is still active now. It's still very intense fighting. It's not the first thing on your headlines, but that conflict continues to wage even 5 years, 4 years later and whatnot. And so the one takeaway from that is just, and this is applied if you look at other conflicts, that premium to the grain market is priced in quickly. If we look at in the case of the Ukraine-Russia situation, you had priced in all of that premium within the first 10 days of the war. If you look at that chart, you got a whole bunch of other reasons that were bullish then. You priced that big spike, that was all done within about 10 days. And then you traded flat after that. That subsequent rally, as you fan out to like April, May, that was tied to actual bullish grain fundamentals. So there's a takeaway from this that we should expect. If we like this as an analog, if we say this is a framework for how grains react, probably as soon as in the next few days here, if not already, the premium tied directly to this Iran situation would be fully priced into the grain markets. That's a premise, if you will. That's certainly far from a fact, but that's what history would suggest. You don't just come in every day and trade higher because this event is still going on. You've discounted what you think the risk is. You've added that premium, and then you tend to, trade steady to flat until some other factor comes alongside and affects grain. So if this is where we're at on prices, and sorry, my slides aren't indexing for me here. There we go. So So that's where we're at on prices right now, and that's why it actually becomes instructive to start talking, what are the other things that'll come alongside this? So we don't have new crop balance sheets yet. We don't have actual balance sheets for this crop about to get to plant, and it won't be till the end of this month that we actually get planting acres, planting intentions report. But what we have is the Ag Forum outlook. We have the old crop balance sheets shown here. This is February, but I didn't change it in the March one, so it still applies. You've got a very healthy 2.1 billion bushel carry out with 13% stocks to use. That is a carry out and stocks to use level that's not associated with corn rallying much beyond the price that it's at right now. When we've had $6 to $8 corn, that's been stocks to use in the 9% range or lower. That carry out would not sustain a move above $5 for any length of time, almost no matter what else is happening in the world. So that's one thing to take note on old crop. When we fan over to, well, how does new crop differ? USDA in their Ag Forum outlook is actually pegging that corn acres would drop nearly 5 million bushel year over year, substantial year over year drop. Last year's number, when all the dust settled, was record high, the highest levels in almost a century, almost back to the origin of their data set. So it's not surprising this would drop somewhat and so forth, but they're saying a 5 million bushel acre drop. If you run that through their projected balance sheet, your carry out is getting a little bit tighter. It's dropping 250 million bushel, but you're still at a very comfortable 1.8 billion bushel carry out. So that's important to know. You're not in a framework today that says, wow, we're on the cusp of a huge rally. You're getting closer if that acres number proves accurate, but you're not there today. If we look at soybeans, so they're at a 350 million bushel carry out for this year, 8% stocks to use. In the world of soybeans, that's actually not absurdly tight. We've seen much tighter carryouts than that for soybeans, and then they're a beneficiary, at least in the USDA's mind and their Ag Forum outlook. They're a big beneficiary of the reduction in corn acres. Those flip over to beans. You make some demand assumptions. You're increasing crush, but keeping exports relatively low, and you end up with the same carryout in 2026 as you do in 2025. One thing you could say about these Ag Forum numbers is they won't be this. This isn't what the numbers will be. They'll change a bunch, but this is a decent starting off point. So we look at those are our balance sheets for going into the year. They're improved over the 25 ones that saddle us with mediocre prices for the whole year, but they're not set up to be super bullish. They're certainly not set up to be associated with the type of rally we had in the last bull market, at least not yet. We talked about the Iran situation. What else changes? What else influences price? Big one on the demand side, this administration has been pretty consistent on we're going to expand biofuels. One of the ways that we're going to help ag prices and maybe deflect some of our tariff impact and some of that is we're going to support biofuels. So weird political stuff around this, but essentially they've said, bring us a year-round E15 bill and we'll sign it. Get your differences worked out among the various stakeholders, bring us this bill and we'll sign it. They've said just yesterday, leaked, if accurate, leaked renewable volume obligations, how much the EPA sets every year, the thresholds for the various classes of renewable fuels, and the leaked volumes yesterday have been very bullish to, not very bullish, but reasonably bullish to soybean oil. And if you look at this chart, soybean oil has been rallying since back at the start of the year based on this, based on the changes around RVOs are going to be small refinery exemptions, limiting imported used cooking oil as a feedstock. All of those things are going to be very supportive. That's why soybean oil is rallying. That's why canola is rallying. That tone has turned really bullish. And in amongst this, you've started to get some clarity on the 45Z tax credit language that would allow producers that qualify, fuel producers, ethanol plants, crush plants, et cetera, to actually monetize their low carbon fuel, and that also be really bullish. So the biofuels front is probably the most bullish it's been since back in 2007 when you ushered in the RFS2 and built all the ethanol plants and whatnot. So that's supportive, but again, that's not new. these are things that are priced in right now. That's some of what's helped us get to this point. So there's still some risk on these stories if we fade back from what the market thinks today. All right. The other thing on the demand front, despite the big US corn crop, world corn demand has stayed incredibly strong. It's outpaced supply through these last two big Western Hemisphere corn crops. This chart, Dalian corn futures, that's the name of the Chinese grain exchange. That's Chinese corn futures, if you will. They're at contract high prices right now. They've been surging since back in December. China, at least on paper, at least what they told us and told the world, is they had a big corn crop, but also widely known that whether it's as big as they say or not, that they had major quality issues with that crop. They had a super wet harvest. We know in North Dakota what kind of challenges come with that. So their prices have been surging as feed customers look for alternatives. And it's just worth noting, even at taking their data at face value, where they show record production almost perfectly stair-stepped every year, their demand is still outpacing their ability to produce corn domestically. So this is a structurally bullish. When you start seeing corn falling into the low $4 and whatnot, you can be pretty confident you've got support there, because worldwide that's too cheap for corn. And this bears monitoring. We're pretty early. China's on the same growing season we are in the Northern Hemisphere. We're not even halfway through the growing season. Their prices, as in the crop they just harvested, and prices rallying like this. So this bears monitoring pretty closely. This is still unfolding. This could be more supportive if you see China and actually importing feed grains again for the first time in a few years. The other thing that's worth noting, this is not an opinion on current fundamental factors, but just the broader seasonal on grains that are so reliable. You're rallying early into the seasonal right now, but grains have a strong tendency to rally from basically around December timeframe to make a high in that May, June, July window. The last 2 years were very counter seasonal. Your highs came much sooner. You didn't have much for summer rallies. If you set those aside, it's very common over the last 40 years that you have a spring to summer rally. So you're in the window now that normally, absent what is happening with Iran pushing its grain prices, you would not be out clamoring to sell corn and beans in March. That would be just on the cusp of what should be a much bigger seasonal rally. Okay, so talked about the Iran situation being supportive to grains, getting close to priced in, but supportive. We talked about the administration pushing biofuels as supportive. We talked about you're in a supportive seasonal time frame. Corn acres are dropping. That's tightening up balance sheets just a little bit. You've got strong global demand for corn. I think the warning sign in all of this right now, without getting too wonky, without getting too down in the details, as this rally's been happening in the short term here, at least over the last, call it 2 weeks, cash markets have been collapsing, and that's very unusual, and it is a big warning sign. So corn futures have rallied 30, 40 cents in here. Spreads have widened, more carried. We don't want your corn now. We'll pay you more to store it. And then basis locally has almost penny for penny backed up alongside that rally. So this is a big warning sign. You are not structurally short corn or beans at all right now on the front end of this. There's plenty of this. The cash markets are well supplied. That is a very big tell that's going on. One other, if warning sign is the right word, so we have a lot of our own, all of our analytics are our own. We have a lot of really unique stuff we look at Lighthouse. And so one of the things we have is a market gauge that tracks the expected price range for corn, beans, and wheat, giving their current stocks to use. So there's pretty good correlation on those. The higher the stocks to use, the lower the price range it tends to trade in. Right now, corn, beans, and wheat are in the 75th percentile or higher of their price to stocks to use. And the white on this chart highlights times when that's been the case, when all three of them have been 75th percentile or higher price stocks to use. And in typical grain trading fashion, of the times highlighted here, all but one of them featured huge subsequent collapses in price. The one time that didn't featured a huge rally. So most of the time, all but once, when we get to this point, when price is this high relative to our stocks to use on corn, beans, and wheat at the same time, it's very uncommon for a rally to continue. So that's another warning sign in all this. All right, so you can synthesize this into some expectations then. This chart on the screen shows new crop corn January 1st, rallies from January 1st into the expiration of that contract. How much of a rally from our January 1st price did we see? Those big bars, ignore them. Anything that gets up onto the third or fourth level of that chart, those are bull market years. Those are years we had tight carryouts to begin with, and not surprisingly, we had huge rallies. If we look at years that have stocks to use similar to this year, virtually all of them featured a rally of at least 7% and no more than 17%, with a high coming somewhere between April and July in almost every case. Soybeans are real similar, so we're just to move it along, we're just going to focus on corn to extrapolate the same for soybeans. So if we look at all that and we fan back to that Jan 1 price, what we were saying, we did say this in the next trade segment and around the 1st of January, we could say based on our 440-ish corn then, we should expect December corn to have a high somewhere around $5 and November beans to have a high somewhere around $11.70. These were things we were talking about back in early January. That fits the analytics we just made you guys sit through, and it fits this historical rally percentage. And those expectations still hold today. And what makes that interesting is those are kind of prices we're right at right now. So instead of making some of these decisions in June or July, we're kind of getting them put right in front of our face right now. So we'll talk about what to do alongside that here shortly. But first, Jory is going to take us through margins. Before he does that, any questions on the markets? Like I said, the convenience of webinars, what you give up is you can't read people's body language. It's a hard time to nudge a question in during the presentation. Any questions on the markets themselves? We'll circle back with more Q&A at the end, but any questions on anything related at all to what's happening here in the markets? And if not, and noted to at any point along here, you can type in a question on the messaging thread on this, and we would get to it then too if that's an easier way. So, but then I guess, so we talked about the market outlook. What goes hand in hand with that is then just what are our margins? What is that farm looking at for a bottom line and so forth? And I'm going to hand over to you, Dory, to maybe share, I guess, take us through kind of margins here.
So obviously springtime for most of you guys have been through a lot of these numbers with your clients, and I think just we keep the crop budgets up to date around here just so we have an idea when we're going to make these decisions, where guys are sitting at, what the average kind of looks like, so that you can make these sound decisions when the opportunities arise. You see here at just the general budget that we use, we have a lot of assumptions that come into that. I take and use the South Central North Dakota averages from the past years out of the farm business management numbers. Kind of combine that with the NDSU 2026 crop budgets and what they look like. And then I updated this week. Monday, I had talked to a lot of clients that were talking about the price of urea if you didn't have it booked, being up to about $700 a ton right now. I think that, that certainly is an increase and something that needs to be thought about, especially if somebody's going to switch some acres. And then also, in these budgets, a lot of people look at our land cost or yield or whatever, and they want to talk about, well, mine's higher or lower. And certainly it is for a lot of different guys in a lot of different areas. But kind of what I go with there is that land costs would increase. Certainly the yield expectations would increase as well. And so we kind of temper that differences by changing those together. And then these budgets don't include any family living in them. And so that, what it comes down to here is just a way for us to look at, are we at a profitable level when we're doing some of these hedges? And so I guess, Dave, if you want to flip into we can take a look at corn. And on the income side of this, I updated them all with the incomes as of yesterday afternoon using, futures and then an implied basis on corn, a basis of 50 under. You can see that corn costs roughly around 500 bushel an acre, $500 an acre to raise. Puts our profits somewhere on corn around $88 an acre if we're hedging right now on corn. And so corn typically in these budgets, this looks like it's kind of towards that magic number of $100 an acre or whatever, that where it becomes really profitable. But also take in mind that has to cover family living and whatever on a farm. But a number there that certainly would probably make sense to do some hedging at these type of numbers. If we want to move into the beans. And I think the big thing that we look at a lot of times is the comparison of these crops and where do they all fall at, and does it make sense to do some sales. You can also see here beans, same type of deal, using an 80 under basis assumption for harvest, roughly $33 an acre profit on beans, which maybe isn't as high as some years in the past, but definitely also a gigantic upgrade over last year on opportunities to sell beans as well. The next crop, I believe, is wheat. Wheat is the tough one. Even the numbers here would show, even with significant increase over the last 2 or 3 weeks, and the price of wheat is still a tough one to pencil out. And so that makes a lot of the marketing decisions maybe a little bit tougher. I think Dave would agree. Like, you're trying to decide if you should hedge this crop. It's still not at a level that's profitable on very many farms. And so that makes a real tough decision when you're sitting down talking to guys and trying to decide, should you hedge or where should you have some orders at? If you get closer into that $7 futures range on new crop, certainly becomes a lot different discussion. You're probably, a positive number there, $15 or $20 an acre to the positive. And so wheat, to get competitive with other ones, just needs a little bit more time or a little bit more rally here, but kind of always seems to be the tough one to pencil out. And then the last crop, is canola, and canola has made significant moves as well. You're into a level there where, decent to extremely decent profits are available on canola by doing some hedging here now, as long as we get a good yield. I think, one of the things to look at on all this, I had somebody tell me that if they could get, 3,000 pound canola at these prices, they'd have a $750 an acre return. And that gross number per acre still is pretty important when it comes down to this, because all the crops over your whole farm, as you guys all know, make those payments. And so having those kinds of targets or wherever it is makes a lot of sense. But certainly increased yield like that guy was talking about would help too. But this is kind of where we're sitting at right now on all these crops as far as profitability. And as you can see, and you got 3 out of 4 of them in an area where you're making a pretty decent profit. It really lends to kind of like they was talking about markets at kind of what we thought were numbers that were a possibility of a couple months ago being here now and making these hedging decisions. And I think that's where we get into talking about, okay, how do we take advantage of these numbers? So
yeah, well done and well stated, Jordan. Yeah, I think an important context for all the doom and gloom, for all the high costs, low prices, etc. Most guys today have impressive profits on canola, good profits on corn, decent profit on beans, and just wheat it isn't. And as long as guys are deprioritizing wheat as best they can, their overall farm mix looks like this is probably the best budgets today that we've actually seen in 3 years at this stage.
Especially in comparison to last year at this time, these look considerably better.
So now we kind of have a framework of what we think on the markets and what's going on, and you have an idea of where your margin structure is, your break evens, where your costs are. And again, highly generalized on the slides we just looked at, but still generally true for farming with us. Now we know we have some slight profitability. This, nothing you've learned so far is necessarily life changing. You could find a million guys to give you their take on the markets, and certainly the margins is probably stuff you already knew as bankers. You've been seeing these come in and whatnot. Where guys get tripped up and where we want to spend these last 10, 12 minutes is just still nothing happened. And what should this farm be doing about it? What could they be doing about it? And why aren't they doing it? And you really have, we're going to take through an actual example here. This sets up really well to just say this right now on corn, what's something a farm could be doing when you look at all these factors together. I think it's worth just restating the two main mistakes that just torpedo grain marketing plans is, and they feed off of each other. The second bullet point, the thing that hurts in the long term, no matter what, is making sure you don't have delivered unsold grain. You lose on all fronts in that scenario. For the minuscule chance that you would actually achieve some upside on it, you're losing on every other front. You're either storing into a carry or you're paying storage charges. So it's costing you to store that grain. You're also not getting your cash out of the business, so you're incurring interest, and if you're borrowing money, you're incurring interest at the cost of money, and it's very expensive and whatnot. And as a side note, that's not the focus of today. Maybe it'll be on another one, but even if it's not a good time to sell grain, there's way more efficient ways to re-own this grain and to have it just unpriced in town. And a lot of the Hail Mary calls we get from Client Center on this, and they don't usually become Lighthouse clients that we get from prospects. They don't usually become clients. It's some version of, all my corn's in town, it's August, it's been there since harvest, I don't have any good price, I've got 50 cents of storage charges, I need to get $4.50 for it, the cash price is $3.60 today. Lighthouse, we heard you're good at helping people market grain, what can I do? At that point, it's too late. So that's one thing too. Even if that farm did nothing else other than just making sure they didn't have unsold grain in town, they're already going to vault their marketing into the top echelon of farmers, period. So how do you make that be true and still have it be successful sales? That gets into the first bullet point. You have to be set up with a structure to where you'll make incremental profitable sales along the way. That's you're to do this, and it's the mechanics of that are incredibly simple. Now it's a click of a button, and at least at Lighthouse, everything that happens after that's been automated. So it's not a mechanical issue. It's, in most cases, it's actually a behavioral issue, and it's that farm getting so tethered emotionally to this grain that it's got to be worth more. And then we actually live in a world where social media and everything is geared towards whatever we think, we're going to give you more of it. Like that's why your social media feeds are all stories that fit with what you already think and like. And the farm tends to have that problem even before social media. I'm bullish grain, so everything makes me more bullish grain. Every story, no matter what, and it ends up just torpedoing market plans. So it would be incredibly rare the case, one we haven't encountered, where someone successfully markets grain well over the long term that doesn't make incremental sales along the way. And so those are two main mistakes to avoid. How do you do that? So just taking through a hypothetical example here, rallying on corn, we talked about our market bias. We talked about $5 was the upper ceiling, at least price of stocks to use, and maybe the Iran situation unlocks some more upside, but we're talking about that was our target. Those are our budgets. We know we're profitable. We're already set up then now to know, we've achieved an upside level that works and we're profitable. So that sets up kind of the first step of does it make sense to sell here? Like, could I run my farm off of this sale if I made a sale of corn here? Could I farm forever based off of making this type of decision? So certainly it checks those two boxes. And then I think like where you get into, at least on Lighthouse, then how you can further massage this. So we have our own proprietary analytics. you guys are all on this call are probably receiving them, or you should be, just the daily emails, the weekly commentary, the 1 minute next trade segments. And we have price signal and market gauges. So if I'm already, $5 is kind of a fundamental upside target, I'm making money at $5. What do our analytics say? Well, we're at a sell signal on corn, as in this would be a good time to sell it. It fits with selling. That's not a magic. This should be the high. It just means if I'm selling when I have sell signals over the long run, that tends to be a good sale. Well, what about these market gauges? Well, all of them except the seasonal that we highlighted, all the rest of them are in the top half of their range, and price to stocks to use is getting very high. So these market gauges are saying this is also a good time to sell. Like they're very high. This fits with selling. We rolled out at our winter meeting, we take that price signal and those market gauges and we run them through a learning model that says, take all that data for today, show me every day in the past that was at least 78% correlated. The situation on that day was similar, and then show me what happened the next 20 days on those instances. And this was corn on Monday. Only 38% of the time on days similar to Monday was price higher 20 days later. And that's with 150 similar data points. And the average change over the next 20 days was minus 8 cents. So now I've got a fundamental belief where corn's going. I know my margin structure. I'm making good money. Now I've got these high-powered quantitative analytics that say, yeah, this is an okay time to sell. That all is a buttress against that tendency to want to just be bullish no matter what. So that sets this up well. Then you get into a big piece of this where market plans also get tripped up. Where and when do I put this? Okay, I'm in the arena now. Like there's a game here now. I showed up at what time do I get in the game? I know I'm at the right place. So this another just bespoke impromptu chart on Lighthouse. So Monday East corn rallied to 498 and fell to 471 in the span of just a few hours. So there's a big difference between 498 and 471. And it's all, and again, it was literally hours. As a side note, crude oil traded in a bigger range in 3 hours on Monday than its entire range of the previous 3 years combined. That's how volatile Monday was. So now I know I want to sell, and then just, wow, this happened. I wake up, 471's okay. It's sure not as good as 498. It's not as compelling and whatnot. This is the analyst that we did. If you get a spike high like that and then close lower on the day, so you spike way up and you make a new high for a move, and then you close way back down, what happens next? In every single instance but one that we could find, you rallied back to within 1% of that high, if not went on to way higher. So we're sitting here Monday morning saying 498 was the high. We don't need to sell at 471. We should put these orders in the low 490s. Historically, we're going to get back to that level. That feels a lot better. And why that becomes important is if corn ran to 498, collapsed immediately after, you sold at 471 on those lows, and then now it did what it's done now. Your whole marketing plan after that is you have this psychological effect of, but if corn ran to 498, we sold in the 490s, and it goes on and moves higher, good. Like we rewarded this rally, well, we're on to the next one. So that's some of the things of just knowing where to put the order. The last thing, we get asked this from banks actually quite a bit, like, okay, as a concept hedge, I get it, but what does that mean? What are the different contracts? What are the different options? What are the different ways that we could do this? And so there's certainly just one of our edicts here at Lighthouse, simpler the better. Markets rally, make a sale, hedge to arrive, set the right basis later, et cetera. But you get some of these high stakes times, okay, I haven't even planted this corn yet. We got this Iran situation, got the other factors. I really want to do something, but I don't want to be saddled into a fixed price trade that maybe just backs me into a corner. I'm a regular farmer. I haven't learned how to trade options. I don't like, that's the sort of some of these cash contracts that can mimic the benefits of options. Like in this case, maybe I don't want to outright sell at 490 D's corn. Well, I can do a min-max contract and I can put in a 470 floor and give myself a 520 ceiling. So as long as I'm willing to accept that downside to 470, now I have that floor, but I have upside all the way to 520. It gives me a lot better way to just manage that risk. And there's a host of these examples that you can get into in different ways to structure these contracts so that your risk matches up better with what your comfort level is and what your situation is. So now, if I'm saying it's March, the world's a really weird place, but corn ran up to my target, I've got a sell signal on my analytics, but I haven't even planted this crop yet. I own fertilizer, but I hope it shows up. I don't know if it's even gonna or not. It's an example of, well, I want to take advantage of this, but I don't want to get limited if this thing keeps rallying. This is where, oh, okay, this is a spot then that we'll do this min-max contract or some version of it. And now everybody's kind of sleeping a little better. That banker knows, well, this corn, at least however much this client did, at least we got a 474 on it. Farmer knows, well, at least if this is just the early phase of a much bigger rally, I still have upside to 520. That's the sort of thing that can tie this all together. If the goal is to head off all the psychological reasons to prevent that farm from making a good marketing decision, then this is kind of the final piece of the equation. So if I'm that farm and I'm just wired to be bullish no matter what, I'm trying to head that off so I make good marketing decisions, having that opinion on the markets that we just talked about, knowing our margins, having things like a sell signal that says, yes, this is a good time to sell, and then using the right structure to fit my overall circumstances at that moment in the market. Is this crop I have in hand? Is it a crop I'm not even planted yet? Those are the types of things that tend to actually lead to these good marketing decisions and avoid that scenario where I just show up at harvest with no grain sold and it's coming to town and whatever happens from there. So that's what we wanted to talk about. And I think we had at least one question on the messaging, and don't be afraid to send. We'll stay and answer questions as long as there's questions till the last person drops off. So what do you got for?
Says, what are your recommendations for lender commitments to a hedge line per bushel or crop?
What are your recommendations for lender commitment to hedge lines? So that's a really good question. And as a lender, and if that farmer client is hedging in their own brokerage account, your commitment should be whatever margin calls they come up with, as long as those hedges fit the marketing plan that you agree on. Because otherwise you're exposing them to quite a bit of risk. Because that's the risk, right? If I'm hedging these trades myself, if I run out of margin call, I got to get out of this trade then, or I'll be forced out if I don't make my margin call. And that's usually not the time that you want to have that happen. And then you're exposed to actually making your situation worse. So as a general, somewhat glib statement, if that's some of why we talk about the rest of this so much, like if that farmer and that banker are aligned, you should be prepared to margin, as long as they maintain whatever equity amount overriding the whole thing. You should be prepared to margin whatever margin calls they come up with. Otherwise, the whole system breaks down. In a practical sense, something in the neighborhood of 50 to 75 bucks an acre would cover most years. Also, as an aside, if a client is working with Lighthouse, there is no margin calls for them. These trades, these structures, the hedging, those are all cash contracts with Lighthouse. So Lighthouse is left to worry about the margin calls, but that client, that farmer doesn't have margin calls. They're doing cash contracts with Lighthouse. So
What would be the cost like this? The structure today.
And this is hypothetical, but this would have filled at even money. So no cost to this at the moment. That this is not a commercial for doing min-max contracts. This is just to demonstrate there's infinite permutations and situationally there's a lot of times where there's not a blanket thing and whatnot. But yeah, in this case that was just the 475.20 was the zero cost min-max entry point. If no other questions, we appreciate the chance to just, and then if you're not receiving the Lighthouse information flow, make sure you let Jory know. You should be seeing the daily emails and or text. The next trade segments, the 1 minute reels are highly instructive. The daily signal updates, so the more commentary, and then stay tuned. We'll do some sort of lender event this summer too, and maybe something that involves being eyeball to eyeball in person, or at least that option when it's a little nicer out. So we'll be on to the next thing, but otherwise, thanks Jory for putting this together, and to everyone that joined. And if you have questions outside of this meeting, you know how to get a hold of Jory or any of us at Lighthouse. And again, thanks everyone for letting us do this.